Did you know that in certain situations, you could lose up to 30% of your inheritance to hidden tax in Australia? We often hear people say Australia doesn't have a death tax. And technically, that's true. But every single year, Australian families lose hundreds of thousands of dollars when someone passes away. Not because of inheritance tax, but because of hidden and deferred taxes that are triggered by how assets are structured before death. And here's the worst part. Most of this tax is completely legal to avoid if you know the rules before it's too late. Hi, my name is Helen Nan. I'm a certified finance planner and author of a finance book. What I'm sharing today is general advice only, not personal advice. So please make sure you read the full disclaimer below. In this video, I'll show you where the so-called death tax really comes from. The most common traps around property, shares, the insurance, and superannuation, and the practical strategies Australians use to reduce or even eliminate this tax. Let's start with the family home, because for most Australians, this is their biggest assets and the one with the most emotional attachments. Under normal circumstances, your main residence is exempt from capital gains tax when you sell it. This exemption can actually continue after death, but only if certain conditions are met. Generally, the full exemption still applies if the property is sold within 2 years of the owner's death, or if it continues to be the main residence of a surviving spouse or an eligible beneficiary. However, capital gains tax can apply if the property is rented out after death, held for longer than 2 years, or inherited by a beneficiary who never lives in the home. Let me give an example. Sarah passed away owning her Brisbane home. She bought it for $600,000. At the time of her death, it's worth $1.2 million. Her adult son inherits the property. Instead of selling it, he chooses to rent it out for 5 years. He then sells it for $1.4 million. Because the home was not sold within 2 years and it was never his main residence, capital gains tax applies to the sale. The key lesson here is this. The family home can easily become a taxable asset after death, depending on what the beneficiary chooses to do with it. Now let's move on to other capital gains tax assets, such as shares, investment properties, and business assets. Unlike the main residence, these assets sit squarely inside of the CGT system. At death, these assets do not trigger an immediate capital gains tax event. Instead, they are transferred to beneficiaries at the deceased person's original cost base, assuming the assets were purchased after the 20th of September 1985, which is when CGT was introduced. This means the tax isn't eliminated, it's simply deferred to the next generation. Capital gains tax is triggered later when the beneficiary sells the assets or transferred it to someone else. For example, Michael bought blue chip shares for $200,000 in the year 2000. At the time of his death, those shares are worth $500,000 and passed to his daughter. There's no capital gains tax at death. 5 years later, the daughter sells the shares for $650,000. The capital gain is calculated using the original cost base of $200,000, meaning a gain of $450,000. While the 50% capital gains tax discounts may apply, a significant tax bill remains. Now compare that with pre-CGT assets. If Michael had bought those shares before the 20th of September 1985 for $100,000, and they were worth $500,000 at death, the cost base for his daughter is reset to that $500,000. When she later sells them for $650,000, the capital gain is only $150,000. The takeaway here is that the capital gain tax is often passed on, not wiped out. Now let's talk about the superannuation, the area where most families get caught completely off guard. Superannuation does not automatically form part of your estate. It's governed by trust law and beneficiary nominations, not your will, unless it's paid into your estate. And the tax outcome depends entirely on who receives it. For tax purposes, dependents include a spouse or de facto partner, children under 18, financial dependents, and interdependents. Adult children are not generally not considered tax dependents. If super is paid to a tax dependent, it's usually tax-free. If it's paid to a non-tax dependent, tax applies. Typically, the taxable component is taxed at 15% plus Medicare levy, bringing it to 17%. Certain untaxed components can be taxed up to 30% plus Medicare levy. Here's a real-world example. David dies with $800,000 in super. $600,000 is taxable and $200,000 is tax-free. The benefit is paid to his adult daughter. The tax on the taxable components comes to just over $100,000. This is why super is often the single largest hidden tax bill in estates, despite Australia having no estate tax. Let's move on to the life insurance, because whether it's taxed or not depends entirely on how it's structured. Life insurance held personally outside the super is usually paid directly to beneficiaries and generally tax-free. But the insurance held inside the super forms part of the super death benefits, meaning the tax outcome depends on who receives it. For example, Emma held $1 million of life insurance inside a super fund. When it's paid to an adult son, the taxable component is subject to the same super death benefit tax rules. So the insurance is not automatically tax-free. The lesson here is simple. Where your insurance sits matters just as much as how much you have. Now let's talk briefly about insurance bonds, which are often used as tax-effective estate planning tools. Insurance bonds pay tax internally at a maximum rate of 30%. If the bond is held for more than 10 years, withdrawals are tax-free. On death, the proceeds pass directly to nominated beneficiaries. Let's say Linda invests $300,000 into an insurance bond. Over 15 years, it grows to $550,000. When she passes away, the bond pays directly to her son. There is no additional capital gains tax, no income tax, and the distribution is fast and simple. Insurance bond can be a very clean and efficient way to transfer wealth. Now let's bring everything together. John passes away owning a $1.5 million home, an investment property worth $900,000 with a $400,000 cost base. Shares worth $600,000 with a $250,000 cost base. $1 million in super with $800,000 taxable and $500,000 of life insurance inside the super. Everything goes to his adult daughter. While some tax is deferred, significant tax is triggered, particularly within super and insurance inside the super, resulting in more than $220,000 in tax. John thought his estate was tax-free. In reality, the tax was simply hidden or delayed. So here are the key takeaways. Australia does not have an estate tax, but death absolutely triggers tax. Capital gains tax doesn't disappear, it's deferred. Super is often the biggest trap. Structure matters far more than asset value, and with the right planning, much of this tax can be legally reduced or avoided. If you found this video helpful, please like it, subscribe, and share it with someone who still thinks estate planning is only for the wealthy. And if you like deeper videos on super death benefit strategies, structuring life insurance, or planning for adult children, let me know in the comments. To learn more, visit compoundfreedom.au. Thanks for watching.